Alright traders, today's video is going to be a quick but very important one. I want to talk about something that we refer to all the time on this channel called the Triad of price action. Now, I know a lot of you already know all about price action and some of you are probably already trading using it, but this isn't necessarily the same thing as that. So I wanted to quickly explain, and that way you can better understand the times I've referred to it in the past and when I refer to it again in future videos. So in this video, since we want to keep it short, I'm not going to get into all the specifics and the nitty-gritty. I'll get into that in future videos because otherwise we'll be here a long time. And also by doing it this way as an overall concept, it means you can use your own tools or your own approach to fill in the blanks using a method that already works for you. Which means that this approach can therefore be useful for people who aren't even using the Duomo method. It's something for everyone this way. So basically the triad of price action for us is a negative filter, which means it isn't something we use to find trade opportunities, but instead it's something that helps us to avoid certain situations or better judge our position size on a trade. It's helping us to filter through all these opportunities that we find from the rest of our tools to immediately see situations that are safer to avoid. And this is all about the micro strategy, by the way. We're talking about the smaller movements, the micro waves, rather than the macro waves that are taking place. It's what I'd call our last line of defense prior to entering a trade, right? The last line of defense, which is important because the number one rule in trading is that you want to protect your capital. But you obviously need to put your capital at risk to make a return. So if you can have certain triggers that help you to avoid higher risk situations, the better your trading will be over the long term and the more consistent and sustainable you will be as a trader. So as you probably already guessed from the name, the triad of price action is made up of three aspects: trend, momentum and volume. And these are all sorts of grey areas as they all run on their own sort of continuum. I mean, let's look at momentum on its own, for example. This is sort of like saying how long is a piece of string, because you can only really measure something like momentum in the markets if it's in relation to something else, some previous movement, rather than that movement on its own. And that's the same for other aspects of the triad of price action as well. So you really need to think about this when you're selecting a tool or indicator that's going to help you with these three aspects. You need to keep that in mind. As I mentioned before, in future videos, we are going to get into the specifics for each of those three categories to help you out with tools and different approaches to use. But for now, let's just focus on the overall concept. And to explain this concept, I always like to give an example of when I used to go running each evening, but not so much anymore. So there was this amazing park in the center of the city that was from a river which was diverted. So you can imagine it was like really long and relatively narrow, and it was absolutely full of runners each evening. Now, on either side of the park, there was a running path that went the whole distance on each side. So there were options of where you could run, and of course you go one direction or another on each of those paths. So this meant before I started running each evening, I'd assess what I'm going to do. And this was usually based on three factors that are essentially the same as the triad of price action: trend, momentum and volume. So firstly, trend. What direction are the runners going in? If I run south on this path, am I going to go in the same general direction as them, or am I going against them? Next, momentum. How fast are the people running? Is it a light jog, or are they these sort of intense people that train really hard like machines and are going way too fast for me, so I'll probably end up getting in their way, right? And finally, volume. How many people are running there? Is it like a stampede, a big crowd like a marathon, or is it just a few individuals at that certain time? So based on these, I can make my decision. Now, in isolation, these might sound like silly things to decide, but let's think of some examples combining these three factors. Like, what if the trend is against me? In other words, the direction of the runners is south and I want to go north. And what if at the same time the speed is fast, so momentum is high, a lot faster than I want to go, so the movement against me may be rapid and not stop if I get in the way, I'm going to get crushed. But what if the volume is incredibly low? It's just basically one man. In other words, it's one man on his own sprinting in the opposite direction to me. That's not going to be a problem. I'm not really going to get in his way. It's not much to worry about. However, what if it's a group that's running and they're going a bit more sporadic in terms of direction? Some going this way, some going that way, but they're going very fast in terms of momentum. So although they're not all going against me, if I do get caught out, the momentum and the size of the crowd might cause me to go splat. So I'm probably going to want to avoid those situations. Do you start to see what I mean? So these are effectively the decisions that I'm making as well when I'm about to enter a trade. Yes, my tools might have helped me to identify a nice park, and it might be that there's a good opportunity to run there. But when I look at the conditions of the other runners using the triad of price action, I may decide to avoid the situation altogether, or to maybe change how committed I am and be a bit more cautious, a bit more willing to draw away, or maybe just dip your toes in to start with. You know, you have to assess the situation. So in other words, when we look at the market and when we gauge the triad of price action, there may be situations where I get a failure at a significant level and it's an opportunity to enter, but I still might decide not to enter. Or instead I might decide to change my position size either higher or lower based on whether the triad is favorable for me or not, and a combination of the three, whether that is favorable for me. This also counts for when we're exiting trades as well. If the triad of price action is all on our side, we may decide to stay in a bit longer when we reach our target, since along with the structure of the market, we have something else going for us. So things are on our side. We're going with the trend, with the momentum, or whatever the combination may be. So as I said, we will get into the specifics in some coming videos, so you can start to add some meat to the bones of this concept and understand how I do it. But I wanted you to understand what I mean when I'm referring to the triad of price action just on a conceptual level, and start considering some of these situations when you enter or exit your own trades. You know, not all setups are created equal, and we have to use the limited information at our disposal to our absolute advantage. Really milk that information for what it's worth. Now, I definitely recommend checking out the video linked down below, which is about choosing your position sizes. It's got some funny drawings in that video. Now, this video is going to explain in detail how we choose how much money to put at risk on a certain trade, which also considers the triad of price action. But for now, if you want more videos about learning to trade or the financial markets in general, don't forget to subscribe to the channel and leave a thumbs up if you like this one, if you found it interesting or useful. And I will see you in the next video very soon. Take care. Thanks very much for watching.